All right. Well, it's right at 10 o'clock here, so we'll go ahead and get started. Just a couple quick housekeeping items first. So in the chat box at the bottom of your guys' screen, as we're going through the presentation today, feel free to ask any questions that you have during that, and we'll try to field them during the presentation if they're relevant to what Derek's talking about. Otherwise, we'll save other questions until the very end of the presentation and try to get through as many as we can there. I know a lot of the names on here, but for those of you who don't know me, my name's Taylor Morgan. I'm the director of our wealth management department here in McLean County. Joining me today is a pretty familiar face to, I think, a lot of you, Derek Sasveld. He is the director of our investment research and strategy here at Busey. He's also a chartered financial analyst, and really the goal of today is to give you a mid-year market update. Obviously, there's a lot of noise in the economy and the markets right now, so I wanted him to talk through that, but also want him to talk a little bit about the benefits of asset allocation and how structuring your portfolio can really add value to your accounts over time. So with that, Derek, I'll turn it over to you, and we'll go ahead and get started.
Okay, thank you. I appreciate that. Always good to join you, Taylor. Always good to join the Gold Timers. Taylor already talked about the sort of agenda for what we want to talk about. When I discuss asset allocation, I think I'd like to talk about that in the current environment, which is we have an equity market that's very aggressively priced. We've had some recovery from some downside earlier this year for obvious reasons. And the future is somewhat uncertain with regard to the strength of returns that we might see. And I'm going to talk about a couple things in the asset allocation portion, equities and fixed income in particular, where we might want to have slightly different approaches than what some people may have followed over the recent past. But let's quickly look at the economy just for some foundational elements to investing. We'll talk about AI infrastructure, which is a big deal for the economy and a big deal for markets. We'll talk about the labor market and consumers and how the labor market has affected consumers. We'll talk about inflation and energy, which are important, especially for interest rates and to some extent for equity market returns. And then we can talk about housing if you wish. It's a very brief treatment. Housing is a weak area of the economy, and I wouldn't expect it to improve markedly. If we break down the economic growth in the US economy by its components, dark blue, personal consumption, that's usually about 2/3 to 3/4 of economic growth. Yellow, fixed investment, and then government consumption in the lighter blue, and then inventory changes and net exports in the gray. And then the blue line represents the overall sum of those parts. If you look at this chart, you'll notice a few things. Two things I think are most important. One is that consumers and consumption, which typically is about 2/3 to 3/4 of growth, has slackened to less than half of growth in the growth number. And consumption is tied directly to both how consumers feel as well as their pocketbooks. And the feel part of it has, I think, taken a bit of a hit. And with the advent of higher inflation, after inflation, wages have taken a slight hit, and we'll take a look at the labor market with regard to consumption that way. Consumption continues to be positive, but it's been outpaced by fixed investment. And that's highly unusual. That typically doesn't happen. You'll note, and the reason I included 2024 in this chart is you can see how small those contributions in this stacked bar chart were from fixed investment in 2024, and yet these are very meaningful now. Typically, fixed investment is maybe 10% of total GDP growth, 1/10. And these days, it's looking like about half of GDP growth. And I think in the longer run, we could see contributions of 0.5 point to 1 percentage point of GDP growth from fixed investment. That's for the reasons you've heard, which is that data center construction has been remarkable. If we index the amount of data center construction to 100 back in 2019 and compare that to total private construction spending back in 2019, total private construction spending has grown at about 8% per year. And that index of value would be about 161 currently. But data center construction basically has grown sixfold just in the last 6 years. And so that's a significant compound annual growth rate. And that's what's driving that fixed investment spending. It's also driving financial markets. Now, there could be limits to data center construction. There's a lot of pushback politically from people at the local level. I started talking about this 2 years ago with our clients, and at that point, I think I got a lot of blank faces, or maybe some curious faces. These days, everyone's pretty familiar with the data center construction issue and the tie to AI. But I think some of the limits that we've seen are not just political, but they're partly driven by the rise in electricity prices. Basically, for 10 years, when there was some data center construction for what was called cloud computing, basically your email and shopping on Amazon and things like that, that led to roughly about 1% annual growth in electricity prices nationwide, a little more variable in Illinois, for those of you who are still in the state of Illinois. But lately, and since 2022, which is really the advent of the AI infrastructure boom, we've seen about 3.5% growth per year in electricity prices. That's the first time we've seen a sustained inflationary electricity price increases since the 1970s. So this is a new phenomenon, and it's expected to continue. I think it's reasonable that that will continue. Water prices at the municipal level for people who purchase their water from their municipality has grown year over year at about 5 percentage points. That's up significantly from the early 2020s, but it's not totally unprecedented. So I think there are some people who in the data center business who say, well, we get blamed for water consumption, but that's not necessarily the limiter. The key limiter is electricity. And when you think about major technological advances, electric vehicles, cryptocurrency mining, and data center construction, these are all big draws on electricity consumption, and that's going to be an important limitation to what happens with future construction and future AI build out. Eventually, the hope is that AI will be more creative than destructive, and that it will lead to productivity growth. We've had 4 periods of productivity growth in U.S. history since the Second World War that were meaningful. One was the electronics boom in the 1960s that also had a financial market component to it and affected financial markets significantly. Then we had in the 1980s really an improvement in labor productivity that was about business reorganizations. Then the internet after 1995. And the question is, now we've already seen some benefit from digitization and to some extent from data center and AI implications for the economy. But this is expected to continue to grow if it's successful. There are 2 different models of AI, and in different economies. In the US, it's really about hyperintelligence or superintelligence, and that's requiring significant infrastructure build out and the commitment to capital expenditures by our largest tech companies that have plenty of money to spend. But there is also a Chinese competitor to the idea of AI in the US. And it's not necessarily oriented around superintelligence. It's more oriented around industrial policy, which is the question is, how can AI be used in China? And it's being directed by the central government in China. How can AI be used to increase productivity directly in 4 key industries? It's a smaller expectation. It's less impactful potentially than superintelligence, but we've already had a head start in the US anyway in terms of productivity growth. Now, productivity growth is especially important for potentially controlling inflation. We'll talk about inflation in a second, but there are drivers of inflation that are of concern in the longer run. And they're of more concern now than they were last time we spoke. And they're of more concern now than really at any point since 2021. Meanwhile, labor markets have slightly improved. So this is non-farm payrolls on the left-hand side. We've seen a bit of a bounce of late. Non-farm payrolls are noisy, but there are other indications, especially as the expectations of the ceasefire in US and Iran holding. We've seen a pickup in job listings, and we've also seen a modest pickup in small business hiring intentions. And those are important signals for future labor growth. The labor market being good enough has meant that that's supported consumption. Unemployment is 4.3%, which is still relatively low. And as you can see on the right-hand side here, wages are growing. Now, post-COVID, obviously during COVID, unemployment measures went up significantly because of restrictions and business temporary closures. And so we saw a big bump in hiring that happened on the way out of COVID as restrictions were lifted. And then that effect faded over time and labor markets kind of decelerated. Now there's been a little bit of a pickup because of AI, but there's been a little bit of a pickup for other reasons too. And wage growth, which had been somewhat inflationary, has cooled. So that's actually a bit of a Goldilocks result, I would suggest here, where we're looking at basically most measures of wage growth at about 3.5%. That's actually fine and shouldn't necessarily push inflation higher, as was feared in 2022 and 2023 when wage gains were significant and people were switching jobs and people were starting new jobs on the back end of COVID and the lifting of COVID restrictions. As long as the wage growth is higher than inflation, that's also a happy outcome. But as of this moment, we have a bit of a surge in inflation, mostly from energy, but we'll talk about that a little bit more. But as long as people are working and as long as their wages are growing, and incomes indeed are growing, then that makes consumers a lot more confident to even take on additional debt and spend what they normally would save. The savings rate has fallen to 10-year lows, in large part because of that level of comfort that people have in the job that they have and the wages they're making. Also, credit card spending has risen, especially amongst the bottom 50% of the income cohort in the United States. And so as long as people remain employed, remain positive about their employment situation, which people are, and if we do get some benefit of the U.S.-Iran ceasefire holding, then that will have a positive effect as well on consumer sentiment, and that can sustain consumption. So consumption's not the biggest driver in the economy, but it can be sustained. Another reason it can be sustained is that there's a wealth effect. Obviously, the stock market has performed well. Credit markets have performed well. Most housing markets have performed well over longer periods of time, although there's been some big give back in price lately. And so U.S. households in aggregate, in the total, have assets of $205 trillion. Liabilities, mostly mortgage, but some student loan, a little bit more than 20 trillion. So the net worth of all U.S. households is $183 trillion. Now, of course, that's not equally divided amongst income cohorts or income substrates. And so, Moody's.com originally did this analysis last year and they've refreshed it, which is that the top 10% of income earners are responsible for about 50% of consumption. And a big reason why that's the case is that the top 10% of earners are not only making more as a total share of income than they used to, but also they're benefiting primarily from this wealth effect. So those people who have assets are benefiting from a wealth effect and driving consumption. Those who have less assets available to them, say in pension plans or retirement accounts that are a little bit more sticky and they can't fully access them, they're taking on credit card debt and saving less. And they feel comfortable doing so because they are employed and their wages are growing. So those two elements are very important to explain why consumption remains strong in the U.S. economy, but has recently been outpaced by business fixed investment from AI. Now, just briefly about energy prices and oil connected to the U.S.-Iran conflict. The gray bars here represent the 7-day total of Strait of Hormuz west to east tanker crossings. These are official tanker crossings collected by Bloomberg from a variety of sources, including Kepler, which is a well-known shipping data information service. This may not include everything that was done dark when ships turned off their transponders, or perhaps ships that were snuck through either between U.S. and China, or Iran and China, or some of the U.S. efforts, which the president has mentioned. But you'll note that obviously oil is moving through the strait. That has led to a precipitous decline in oil price. Markets anticipated this somewhat. The peak in oil price was back in early April of this year. This is WTI, so the U.S. crude oil price. And really, this has meaningfully come down, especially since the memorandum of understanding was mentioned by the president about a week and a half ago, and then obviously was released to the public. So this will likely continue to decline, and futures markets clearly expect oil prices to decline. And this is a very different picture from where we were April 6, where U.S. crude oil was priced at roughly about $112 a barrel. Now we're looking at a little less than $70 a barrel today, and that's expected to decline in the future. Now, markets always expected this to decline, and we talked to our clients about this at the time in early March and during April, which was this was the market's expectation for oil prices to decline eventually. And indeed, markets have been very aggressive in interpreting what's occurring on the ground as favorable to resolving the situation. Markets are probably amongst the most optimistic people about what's going on, and that is a little surprising to some people who are market participants and investors, but it's not uncommon in these types of situations to see markets anticipate positive outcomes. So the decline of oil price should positively impact inflation. Already, we've seen a rise in inflation. Here I decompose inflation into its components. The dark blue is energy prices. The yellow slice is food prices. The light blue slice is core goods prices. And the gray slice is core services prices. And so you can see that core services is a very important component of CPI inflation in the US in that consumption basket. And especially after COVID, service inflation in gray, you see, were very large components of the overall inflation problem. That was largely because housing and rental saw a surge after COVID and became much more expensive, and that was realized in higher rates of inflation in services, rent and shelter. That's now gone down considerably, and the concern of the Fed and the new Fed chair, which we'll talk about with regard to interest rates, is that core services are no longer a shelter problem, but as you can see, they are rising modestly in their contribution to inflation. So there's some concern at the Fed that non-shelter services inflation continues to rise and is proving stubborn. Another element is you'll note that these light blue portions, the core goods contribution to inflation, disappeared after COVID went away. So the supply chain issues resulted in negative or near zero goods price inflation. But that's back. And when did it start? It started in April of last year with the tariffs. So tariffs have had a small contribution to inflation. Not huge, but small through the rising goods prices. Energy, however, is the headliner, which for the last 2 months of releases, that's April and May for CPI. June CPI will come out about mid-July in terms of analysis. But you can see that the additions there are significant and basically follow the contribution of gasoline and motor fuels to inflation. So this is expected, these are expected to erode away. But you'll note that core CPI, not including food and energy, core CPI is still rising at 2.9%. The Fed's target is 2, and we haven't been at the Fed's target. We've been at the Fed's target of inflation of 2% or less only once in the last 8 years. So inflation remains somewhat stubborn, and it's unclear. Markets are clearly very unclear about what the Fed thinks about inflation and what they plan to do. The new Fed chair has talked tough about potentially raising interest rates and fighting inflation harder and taking away some of the Fed's tools that it used post-financial crisis to reflate the economy, in essence. But many Fed chairs, before they become Fed chair, are very vocal about what they plan to do and are generally sound more hawkish in private life. And then when they join the Fed, they become sort of a creature of the Fed, and over time tend to like the tools that they have at their disposal. We'll see if that's the case with the current Fed chair. But we would expect some of this inflation to come back down because energy prices already in the crude oil space have moved, and we've already seen some reduction in the price of gasoline. But this core inflation issue remains with us, and it's proving stubborn. Finally, I'll just briefly mention housing, which is flat on its back and still weak. Affordability remains expensive. This is essentially if a person purchased the median house in the United States using a 30-year conforming mortgage, this would be the principal and interest payments they would have to pay given median incomes in the United States. And you can see, obviously, that rose along with mortgage rates in 2022 and 2023, and mortgage rates rose along with treasury yields in those periods. Then, starting in about after 2023, but also in early 2025, we saw declines begin in mortgage rates that would have made housing more affordable, but those have been reversed during the war, and they haven't yet necessarily reconciled or come back down. If inflation pressure continues, it's hard to see housing recovering meaningfully because of the cost of housing that's driven by mortgage. The other element, of course, is price, and prices have come down, especially outside of the Midwest in coastal regions. And you can see some of the price decline in coastal regions reflected here, but some of this too is also income. The comparison of median home price to per capita income in the United States is a variable I've looked at for 30 years. And you can see that we've peaked, and that is now becoming generally less of a driver of affordability. That incomes in relation to housing prices have risen somewhat, and housing prices have fallen modestly. We need to see more declines in housing prices, especially in coastal markets, and for this to continue, and for affordability to become less of an issue in spite of mortgage rates. So, housing is still a weak part of the economy. It's usually about 10 to 15% of the economy, and that's a really slow growth portion of the economy at the moment. So essentially, fixed investment and consumption are sufficient, we think, for 2 to 2.5% economic growth. But if fixed investment were to peter out, and if the AI build-out turns out not to be as sustainable as markets think it is, then we may have some issues achieving stronger rates of growth. But that's an issue more for the future and not necessarily for the present. So for the present, the economy generally looks okay, especially because of the AI component. Now, what do markets think of all this? The AI component has been obviously very meaningful for markets, and the chief challenge in markets these days is evaluating the stock market in a manner that takes into account the fact that AI is important and a big contributor to profits and earnings. But by most measures and by most traditional measures of stock market valuation, we're looking at a stock market that's aggressively priced. When we think about asset allocation and positioning portfolios these days, one element is we try to remain diversified as much as we can. I'll show you some information about the stock market that highlights how undiversified it is. Many of you have heard, and we talked last year about the concentration of stock market value in a handful of stocks. That concentration continues in the US, and it's also become a global phenomenon. So emerging market stocks also are highly concentrated in terms of which companies are returning the strongest. And this year, of the top 20 performers in the US stock market, 19 are technology companies. Okay? And almost all have some kind of positive association with AI. Now, diversification generally helps investors weather volatility and weather disappointments should they occur. But that hasn't been necessarily an effective strategy for the last 3 to 4 years because we've seen such strong equity market returns after 2022. But we'll talk about that in a couple different ways. It's important also to have an awareness of valuations. So an important characteristic of asset allocation is to be disciplined about the types of investments one holds and not to get too carried away with concentrations in a portfolio. So we'll talk about US stock market concentration, and we'll talk about non-US opportunities, which some folks have not taken full advantage of, and they've missed out on what's occurred over the last 18 months. So we'll update you on that. From a fixed income perspective, fixed income is important for liquidity, and not enough of our investors, I think, are taking into account the liquidity they might need either in a market circumstance that is negative or in their own circumstances. And we'll talk about the current opportunities in fixed income markets. Fixed income is also very useful for rebalancing or reallocating if there are periods of stress in the stock market. And that liquidity can be used effectively to reallocate or perhaps take on more risk in periods where prices have fallen in risky investments. This also incorporates a consideration of non-US opportunities, and non-treasury opportunities. There's a large set of opportunities in the credit space, but at this moment, whether it's US credit or non-US credit, a lot of that credit is priced for perfection, and we'll take a look at that. And then finally, there can be some prudent use of private investments. There are a number of issues that I think have introduced a little hair to private investments, that there have been some sticky points with private equity and private credit over the last 12 to 18 months. And we'll discuss that with regard to how you may wish to affect those kinds of opportunities. Just very quickly, the stock market is an interesting animal in the sense that in any given year, the stock market in the US has typically fallen at some point during the year by about 10 percentage points. The stock market tends to fall by about 20 percentage points once every 3 years, and more than 20 percentage points roughly every 5 years or so. And these red dots represent the declines within the year or intra-year, and the gray bars represent the total return by year for the whole calendar year. And so you can see that most of these years have had happy endings, but within the years, there has been substantial volatility. And even an undervalued US equity market can fall 10 or 15% in any given year. And indeed, this year we had roughly about a 10% decline around the US-Iran conflict. Last year, we had a 20% decline roughly in the US stock market around Liberation Day with the tariffs. So if you have a strong stomach, yes, you can take full equity risk, but you have to be willing to withstand these intra-year declines that pop up pretty regularly. Valuations are also pretty aggressive in the US equity market. And by traditional measures of valuation, there are a few listed here. Forward price to earnings is the one that's charted that you can see here. And that's the one that most people use these days as descriptive of how markets think about valuation. And that's elevated. It's elevated, which is concerning for forward returns, because historically anyway, over a 1-year period, high valuations, the valuations are shown here on the horizontal axis, generally are followed by somewhat negative returns, but over a 1-year period, it's a very weak relationship, right? This is a big scatter plot. But over a 5-year period, 5 years after a given valuation is observed, if we look at today's valuation, that's been associated with 5-year returns in the equity market in the US of less than 5 percentage points per year. So there is an inverse relationship between valuations and longer-term forward returns, which causes us some concern. The offset to that is that earnings have grown substantially. Okay, and earnings drive stock prices. This is the accumulated earnings of all the companies in the S&P 500 since 1990. And these are growth rates, year-on-year changes in the total earnings of the S&P 500 companies if you added them all up. You'll note something interesting about especially the first 20 years of this relationship, that we saw 20% year-on-year growth or slightly greater, especially after recessions when there were recoveries from the business cycle or in the broad economy. That happened in the early 1990s. It also happened after the tech bubble burst in the early 2000s that caused a significant recession. It especially also happened in the wake of the financial crisis and then the efforts of governments to stimulate in the wake of the financial crisis. And it also happened after the brief COVID recession. But there are a couple other observations. In 2017, we had corporate tax cuts that drove earnings growth above 20% year on year. The first time we had had a non-recovery after a recession growth in earnings of that strength. And we're seeing that again now, simply because, or largely because, of the AI build out, which has led to explosive earnings growth in semiconductor companies, other hardware companies, and the AI hyperscalers. So 20% earnings growth year on year is unusual. It's usually seen after recessions during recoveries. We did see it with the change in the tax code in 2017, so it's not totally unprecedented outside of recessions, but this is unusual. And so I think it's fair to say that it's going to be difficult to sustain this kind of growth, and markets are expecting roughly about 20% earnings growth for the next 2 calendar years out of the S&P 500, and that's going to be difficult to achieve. The concentration of the U.S. stock market is extreme in the case of a handful of securities, but it also impacts a couple other things with regard to asset allocation. Sector allocations are very heavy to technology in the U.S. equity market. Roughly about 38% of the U.S. equity market is invested in information technology companies. Also, communication services and consumer discretionary were bolstered by companies that we would most likely identify as tech. Communication services includes Meta or Facebook, also includes Google. Consumer discretionary includes Tesla, also includes Microsoft, also includes Amazon. So these are, and Apple. So these are bellwether tech names that have done very well and are even outside of the technology sphere, but we might think of them as technology companies. So it could be thought of that the U.S. equity market is almost 60% weighted to technology companies because technology type names dominate in these two sectors as well. That's highly unusual. So the sector weights in Europe, the sector weights in the U.S. prior to this experience, the sector weights in emerging markets are more diversified and have more representation of sort of industrial and other names, healthcare and staples, that help to diversify a total portfolio. So the concentration of the U.S. equity market is a danger, not just in individual names, but also in the sector concentration. Non-U.S. opportunities have less concentration in technology, and that can help cushion the blow should we see some negativity or disappointment in technology companies going forward. Globally, the U.S. stock market being so heavy in technology has benefited it. And those companies have earned their status and their size. But the U.S. stock market, which was once about 1/3 of the global stock market, that's this slice here you see in blue, is now roughly 2/3 of the global stock market. So that's basically doubled in the last 20 years or so in terms of its representation of the global stock market. The global stock market has, in essence, become less diversified because it's become much more American and much heavier in technology. Developed markets outside the U.S. have lost a lot of that share, and emerging markets have been pretty consistent in terms of their share, 12% currently and about 10 to 12% historically. So there are other opportunities in the world, and there are opportunities to pursue some diversification. That diversification really is sector oriented, and it's also, you can think of it as counter-cyclical if technology shares are cyclical. Performance outside the U.S. for a long time disappointed. And so what we show here are annualized 15-year returns. The 15-year return of the U.S. stock market was 14%. That's very good. And the components of that largely were earnings growth, this slice that's in the dark blue, but also some multiple expansion of prices beyond what earnings were growing. And then there's also a component of dividends, which is relatively modest. Obviously, the U.S. market doesn't have any currency translation that benefits investors or costs investors. Currency translation cost investors outside the U.S. for much of the last 15 years. And although earnings growth was pretty strong outside the U.S., especially In Japan, this second tranche you see here compared to the US, non-US markets really in part because of currency, but in part because of a little slower earnings growth, didn't compare to US particularly well for 15 whole years. But some of that has changed. In 2025, we saw some currency appreciation, especially in the Eurozone, but we saw a lot of multiple expansion and some healthy earnings growth in parts of the world that meant that non-US stocks outperformed the US considerably last year. And we had some considerable positions in our portfolios that benefited our clients. This has continued into this year, with emerging markets in particular and Japan continuing to be strong and better performing than the US. The Eurozone always may be a slower grower, and China has long-term challenges to its growth rates. But you should know that the performance of non-US stock markets has improved significantly lately, and that may continue. It especially will continue if the US dollar, which we believe is overvalued, depreciates, but it also may well continue if valuations outside the US are recognized. So the average valuation in the US equity market on price to forward earnings I talked about before is about 21.2, which is at historical high levels. Outside the US, these valuations are more attractive in the high teens and in the mid-teens. Also, by sector, these purple diamonds represent valuations that sector by sector are more attractive outside the US in every sector of the equity market. So valuations aren't everything, and valuations outside the US have been more attractive for a while. But at least for the last 18 months or so, calendar year 2025 and into 2026, we've seen stronger performance out of non-US securities. And that's an area where a lot of investors are underallocated. Now, with fixed income, we face an interesting sort of longer term picture. So just as with equities, there may be some sort of changes in the guard in the longer run, that the US has been a big winner for the last 15 years or so relative to other geographies, but that may not always be true forever. We've had an interesting change in fixed income, where yields have finally risen after long periods post-financial crisis of the Fed suppressing interest rates. What I show here is the dark blue line represents 10-year Treasury yields, and the gray line represents 3-month T-bills or cash. And this goes back to the early 1960s. Back in the early 1960s, we had inflation that was 2% or less on a sustained basis. But then the war in Vietnam and then other issues in the economy, especially volatility in energy prices, caused an increase in inflation to the extent that you may recall that in 1968, Richard Nixon tried to freeze wages and prices and institute wage and price controls because of inflation that had been runaway to that point at 4 percentage points. Then, of course, with the energy crisis in the 1970s and the Arab oil embargo, and then other issues in the early 1980s, we had very high rates of inflation that reached basically 14 or 15% in the early 1980s, and cash rates followed. Also, so did long-term bond yields. Then the Fed in particular, originally in the form of Paul Volcker, if you remember that name, and then eventually other Fed chairs, including Alan Greenspan, who recently just passed, and Ben Bernanke also held this view. The official policy of the Fed was something called opportunistic deflation or disinflation, that they wanted to suppress the inflation rate by managing the money supply aggressively and tightly. And they did so, and they were successful. And they brought interest rates down for a long time period to their bottom in late 2021. This meant that investors were used to realizing price appreciation of their bonds. If they had bought bonds any time in this period, the interest rates that fell resulted in positive returns, not just from clipping the coupon or receiving the interest, but also the fact that the price of the bond rose because new and more recent interest rates were lower. This reached its strongest point, especially post-financial crisis, where the Fed kept interest rates near zero, and that helped to suppress interest rates more. That led to more pain in 2022 when yields rose, and that meant price declines in fixed income. And indeed, in 2022, we saw the stock market and the bond market decline in the same year for the first time in a long time. And bond returns were the lowest they've been in any calendar year since the late 1970s and early 1980s. Now, the good news currently is that we're looking at an environment where yields are higher, and bond investors should probably get largely most of that yield if prices don't change significantly. But if we have stronger inflation pressure, and if U.S. Treasury debt, which is growing, is harder to market, those yields may increase more substantially in the future. And what we've seen for the last 4 years or so may be more like what we see in the future from bonds, maybe not the same strength of rise in yields that we saw specifically in 2022 and 2023, but a more elevated and rising interest rate environment is going to be a harder environment for equity. It's going to be a harder environment for private investments, and it's going to be a tougher environment for companies generally to generate earnings. And we'll see if that has some implications for how investors build portfolios. I think that means that you should have more respect for fixed income, and especially more respect for the lowest risk fixed income, which would be treasuries. Another element is that in the fixed income marketplace, the strength in profitability that we've seen in U.S. companies and non-U.S. companies has meant that credit yields have come down substantially too. This is the extra yield. Each one of these lines represents the extra yield you get over a similar duration or maturity treasury for U.S. high yield corporates, formerly called junk bonds in the dark blue, emerging market debt in the light blue, and U.S. investment grade corporates in gray. And you'll note that the extra yield you get for high yield is back down to where it was, say, right after the early recovery from COVID. Emerging market debt in particular, that we have held in our portfolios in a significant amount, is now back to 2006 levels in the extra yield you get for the risk you're taking. And then investment grade corporate bonds in the US, are also back to essentially 2006 levels. So in our taxable fixed income accounts, where we manage bond by bond for our investors, we are buying treasuries for the first time in a number of years. We've held a good deal of credit risk, investment grade credit risk, but our appetite for that is variable along with the reward we're getting. So I would say to folks that you may like the extra yield you get from riskier credit investments, but the reward you're getting is insufficient for the risk. And it would help to hold a little more treasuries and to think about treasury investments and perhaps municipal bond investments as a greater share of holdings in what you have. Now, the levels of income that you receive are going to be lower, but that's using fixed income for in my view, its proper purpose in the current environment, which is if you want to take risk, it's still appropriate for profitability purposes to take equity risk. You have to be careful where you take it. But credit risk is not really sufficiently compensated. And so, you should think about holding safer money and liquidity money and income money in treasury, and then perhaps doing what you can in municipal markets to take advantage either of solid U.S. municipals that have relatively low default rates in the investment grade space, which have tax equivalent yields of 5.7%, or even high yield municipals that we are strongly considering allocating a number of our clients to currently that pay tax equivalent yields higher than 8.5%. Now, keep in mind that the tax equivalent yield here, I'm adjusting for a 37% tax rate. That's the top bracket. There are other adjustments you can make, including additional investment income taxes. But there are opportunities in municipal bond markets, and their default rates typically are much lower than similar volatility credit instruments. Another appropriate thing to do is still to consider private investments. I'm not here to talk about how fantastic private investments are, but they can be appropriately used to gain access to parts of markets that public markets no longer provide. There used to be, when I got into this business in the early 1990s, about 7,500 stocks in the public stock market in the United States. These days, that's been fallen by more than a half and is roughly a little bit more than 3,000 companies. That's because fewer and fewer companies are coming out in initial public offerings as smaller and medium-sized firms. Many more are being incubated in private markets, either in venture capital or in private equity in the form of buyouts or growth equity, and grown as larger and larger companies that eventually IPO. Obviously, SpaceX is a great example of this. So are many of the so-called Magnificent Seven and the biggest, most successful tech companies. Almost all of those companies grew into significant size before IPOing in the public market. So there are opportunities in private markets to get access to types of companies that one may not get in public markets. And that's one reason why larger companies have outperformed mid-size and smaller companies historically. But you have to be careful about the risks you take because the risk levels that many of these investments report are not necessarily comparable to what's available in public markets. But equity investments in private markets, some credit investments, and then other private investments, especially in infrastructure and some even in real estate, can be helpful to diversify a portfolio and still may be appropriate. Now, private credit is going through a bit of a difficult time because there have been some defaults in some names, but those defaults and the default rate of private credit still runs behind high yield credit in public markets and senior loans in public markets. So I think there is still some consideration that investors can make either for income, which can be attractive in private markets. And if you have questions about that, we can discuss. But a prudent use of private markets is appropriate by investors. I would not overinvest. I don't think for any client we recommend more than 20% of a portfolio invested in privates. But those can be helpful, both from a return generation standpoint or opportunity, as well as potentially managing risk. But you have to be able to accept illiquidity or the inability to turn these investments into cash or to rebalance the portfolio easily. That private markets element is going to be more difficult to manage. And those instruments that are more liquid have been the ones that have had more trouble lately in marking to market or providing redemptions to investors who have concerns about some disappointing returns, especially in private credit. The other issue with private investments is that you have to choose successful managers to be successful. Unlike in, say, the US large cap equity market, where a typical investment in a mutual fund will yield you a market-like return, plus or minus, usually a single-digit percentage. And in bonds, that's even tighter. The average manager in a fixed income portfolio generally outperforms or underperforms the index by very little per year, usually about 1 to 2%. In private markets, that spread can be very significant. In real estate, there have been a large number of managers that have actually provided negative return performance. And in venture capital, there also have been some firms that have failed most notably. But those that are successful have generated returns that far outpace public markets and their private market brethren. So you have to choose carefully. And choosing carefully yields better results than it does in public markets, where there are more risk controls that managers use relative to the investments that they follow. So just to summarize, from an asset allocation standpoint, we have some concerns about the elevated valuations in equities. There clearly are earnings that are driving that. And so our stock team that has successfully managed equity portfolios historically to a good extent is trying to invest as much as they can in quality technology companies. But from an asset allocation standpoint, now is an important point to emphasize diversification, both because the stock market is highly concentrated and because valuations are aggressive. If there are any disappointments in earnings, then there will be problems in the stock market in the US. That can be cushioned with smaller and mid-sized company allocations, but also non-US stock allocations. And it would be helpful to still have a slug of treasuries in a portfolio, especially lower risk treasury fixed income, in order to generate some yield, but also provide liquidity and be able to reallocate should we see trouble in equity markets. We're aware of stock market valuations and are continuing to access non-US markets to the benefits of our investors and our portfolios. You don't want to miss out on some of those opportunities that may be very different from the return profiles that we've seen for the last 15 years, and we can talk about that in the Q&A. Again, in fixed income, be careful about taking too much risk in credit, which offers somewhat higher yields than treasuries, but the risks in those investments are much greater than the compensation that is currently available. We would wait for better opportunities that way and be more conservative in what we would hold in fixed income. And then it's appropriate to use private investments prudently, but those who over-allocate will have difficulty and have had difficulty, and you have to be careful about selection because the managers you have will determine the outcomes that you see. Okay, that's it for my prepared comments. If there are questions or comments that anyone wishes to make, I'm happy to take those.
Awesome. Thank you, Derek. Yeah, if anybody has any questions, we'll kind of stick around here for a few minutes and see if any come through the chat box there. In the meantime, while we're waiting, I did want to say that this is being recorded. So we will get this uploaded on the Gold Timers website for you all to go back and look through. Also, after you leave here, if you have any other specific questions to your guys' personal situations, feel free to reach out to us. We have an email inbox. It's just goldtimers@busey.com. Send any questions to that, and we'll make sure that we get back to you as soon as possible and address those for you. So,
and I would just take this opportunity to say that our expectations are for positive returns for equity markets, even in the U.S. equity market, because earnings still look achievable, and those earnings should be successful at allowing support for stocks. But that can change. And if there are disappointments with earnings, then there will be additional downside that we see in the future. Maybe not necessarily enough to derail the economy or create a recession, for instance. Our expectations are low for that. But disappointments in earnings growth can happen from time to time. Back in 2018, you may recall that after the big bump in earnings growth that we saw in 2017, there were some disappointments in the closing end of the year, and the stock market lost 20% of its value in the 6 weeks before Christmas. I'm not saying that that will repeat itself, but there could be additional downside in the future. And it's appropriate for people, when they think about their allocations, to think about how they would organize a portfolio to react in that situation, and what is the best plan to preserve some capital and then be a little more aggressive when buying opportunities come out. We saw that a little bit earlier this year. We certainly saw it last year, in the middle of last year, and we could still see opportunities like that in the near future.
Thank you, Derek. Yeah, I'm not seeing any questions coming in here. So with that, we'll end things. And as I mentioned, if you guys have any other questions, feel free to reach out to us. Again, that inbox is goldtimers@busey.com. We're happy to address anything that comes up. And thank you all for joining today. Thanks, Derek.
Thank you.